Hello everyone, welcome to SamDaisy webinar on exchange traded funds, more commonly known by their initials ETFs. This is the outline of what we'll be covering. Starting off with the equities market, discussing why stocks are so important. Then the main part, we'll cover the basics of exchange traded funds. We'll talk about funds, indices, defining ETFs and how they're created. And then we'll discuss types of ETFs by asset class, followed up by some crucial points about costs and synthetic replication. Then we'll look at some of the most frequently asked questions about ETFs. We'll finish things off by looking at investor psychology and discussing investment strategy. A quick introduction about myself. I'm Niall. I hold an MBA in Risk Management and Insurance, currently a wealth manager at SamDaisy Switzerland. So why prefer stocks when there are other financial instruments available? The simple answer is that stocks go up in value in the long run. The US stocks have consistently outperformed inflation and have generated real returns despite various drawbacks. There has never been more money supplied by the government than it is today, and all this money goes into assets. And as a result, we have asset price inflation, which is an economic expression for when the prices of bonds, shares, their derivatives, real estate, and other capital goods increase in price as opposed to inflation of goods and services. And right now, asset price inflation is mostly in stocks. To drive home my point, stocks have increased 4 times since 2009. And this brings us to the financial instrument that makes it easy to invest in the broad stock market, exchange traded funds. But let's start off with the perfect context. What is a fund? At its core, a fund is a collection point for investors' capital. The way it works is that thousands of investors pool their investment together in a fund, and a professional, the fund manager, invests these funds as profitably as possible while diversifying. But these investments are done according to a planned investment strategy. It is through this investment strategy that allocation of funds to various asset classes, such as bonds, stocks, commodities, is determined. But bear in mind that in a fund, an investor's assets are segregated, which means that the funds are held by a depository bank separate from the company assets. And this is to protect investors' money in case investment company becomes insolvent. The typical investment fund is active, which means that the fund manager is responsible for achieving returns higher than the benchmark. This active fund management is different from managing index funds. What is an index fund? An index fund represents the development of an index as accurately as possible. The components and the respective weight in an index fund are exactly the same as the index itself. If you invest in an index fund, you have the advantage of knowing the exact composition since it replicates the index. For instance, the underlying composition of Euro Stoxx 50 is known at any given time. Euro Stoxx 50 is the European stock index and holds 50 of the largest corporate stocks of Eurozone in a proportion determined by their free float market cap. In an exchange traded fund or index fund, there is no complicated mechanism for stock picking. It is simply a replication of an index as opposed to active funds. And this is why managers of index funds and ETFs receive small annual fee. Talking specifically about exchange traded fund or an ETF, it is exactly what it sounds like, a fund that's traded on an exchange, like the stock of a company. ETFs combine the benefits of intraday trading and liquidity of stocks with the diversification of index funds. A simple way to understand ETF is to imagine an asset manager that buys a bunch of assets, say 100 stocks of FTSE 100 and puts them in a fund. To be clear, FTSE 100 Total Return Index tracks 100 largest stocks in the UK. Now, the asset manager gets this fund listed on the stock exchange like a company and issues shares to the public. An actual example of this strategy is iShares Core FTSE 100 ETF. It is an ETF that seeks to track the performance of FTSE 100 index. Now, the names of many ETFs might sound too long and complicated, but when you break them down, they make sense. For instance, the iShares represents the family of exchange-traded funds managed by BlackRock. It's an American global investment firm, and it's the world's largest asset manager with about $5.7 trillion asset under management. Core FTSE 100 part represents the investment style, which in this case is to track the performance of FTSE 100 index. And the last part, UCITS, stands for Undertakings for Collective Investment in Transferable Securities. Well, in simple terms, it only means a European mutual fund. And here it represents the investment structure of the ETF. Similarly, you can break down Vanguard S&P 500 ETF. Vanguard is a huge name. It's an American investment advisor with over $4.5 trillion of asset under management. The S&P 500 part is the investment style, which means that this ETF tracks the performance of S&P 500 index. When the underlying assets, the assets that an ETF is holding, appreciate in value, the price of that ETF on the exchange also goes up. Conversely, when the assets depreciate in value, the price of the ETF on the exchange goes down in value. ETFs go through price changes during market hours as they are bought and sold, which is why these typically have higher liquidity and lower fees compared to mutual fund shares. This makes them an attractive investment for individual investors. Before moving forward with ETFs, let's briefly take a look at some of the major indices, as these will make it easier to understand ETFs. First off, S&P 500, or Standards & Poor's 500, is based on 500 large US companies listed on New York Stock Exchange or NASDAQ. Dow 30 or Dow Jones Industrial Average is based on stocks of 30 companies. NASDAQ Composite represents the stocks that trade on NASDAQ stock market. And MSCI's All Country World Index. You'll see many ETFs tracking this index. It covers 11 sectors and captures global stock market activity. DAX is a stock index representing 30 of the largest German companies listed on Frankfurt Exchange. Eurostoxx 50, we've already looked at it. It's made up of 50 of the largest and most liquid stocks of Eurozone. FTSE 100, it's an index of 100 blue chip companies listed on London Stock Exchange. And SMI, which stands for Swiss Market Index, it comprises of 20 large and mid-cap stocks of Swiss companies. It's a good practice to know various indices as it helps to understand the strategy of various ETFs. You can study ETFs in many ways, such as you can filter them according to countries or regions. Here I'm talking about them based on their 6 main asset classes: equity, bond, commodity, money market, precious metals, and real estate. Equity ETFs are concerned with stocks, either tracking an index of stocks or simply having stocks as underlying assets. The largest ETF in the world is an equity ETF, SPDR S&P 500, and as the name suggests, it tracks or replicates the S&P 500 index. SPDR or SPDR is managed by the State Street Global Advisors, which is a trademark of Standard & Poor's Financial Services. Equity ETFs fall into 3 main categories: broad market, sector, and beta ETFs. Broad market ETFs provide exposure to all sectors in a country. These typically track the benchmark equity index or indices. When you buy the shares of an ETF that tracks an index, you receive full market exposure at a very cheap cost. For instance, if you want to invest in the whole German stock market, the easiest way to do that is to invest in a broad market index through an ETF. Now in Germany, there are 3 main indices that track the German stock market: DAX, FAZ, and MSCI Germany. The DAX price index tracks the 30 largest German stocks listed on the Frankfurt Stock Exchange. And if you buy the share of DAX ETF, you get exposure to the largest, most traded 30 stocks of German stock market. Sector ETFs, as the name suggests, provide exposure to different sectors. Investors and economists group companies according to the industry sector which they are most exposed to. And it's logical because companies operate in similar areas of the economy, where they face similar challenges and find similar opportunities. Furthermore, these companies are impacted in a similar fashion by any development in the economic cycle. For instance, a particular car manufacturer might be making better or more efficient cars than its business rival. But when the government makes changes to its regulations, which result in, say, an increase in the cost of raw material, or if there's a recession in the economy, all the car makers will be affected. And that's why companies are grouped according to sectors. And this is the reason for the existence of sector ETFs. Investors get exposure to a basket of stocks in an industry sector by purchasing a single ETF. Let's take the example of MSCI World Healthcare Index ETF, which tracks the healthcare sector of developed markets across the globe. And top holdings include Johnson & Johnson, Novartis, Pfizer, and Roche. Now just imagine, if you wanted to invest in the healthcare sector on your own without ETFs, you would have to buy various company stocks or invest your money into an actively managed healthcare fund. This would have been quite difficult since you would have to pay a higher annual fee, and you'd also be dependent on your fund manager's decision where there's a risk of underperformance. In comparison, when you purchase sector ETFs, you can enter and exit different industry sectors at very cheap rates. What this means is that ETF investors now have more choices with portfolio construction when it comes to equity holdings. You can diversify across sectors instead of diversifying by geographical regions. For instance, if you want exposure to the European banking sector, iShares Euro Stocks ETFs tracks the performance of an index of companies from the Eurozone bank sectors. You can also utilize sector rotation strategy. The benefit is that you increase your holdings in sectors that are most likely to benefit from the next stage of economic cycle. Conversely, you can lighten up specific sector holdings if the economic conditions or changing regulations will negatively impact those sectors. Of course, you don't have to adopt frequent trading or portfolio rebalancing tactics. You have the choice to permanently overweigh those sectors that you think are the best prospects for the long term. For example, if you think that the healthcare sector will benefit due to the rising global population, you can simply hold a large position in the healthcare sector ETF. And this brings us to the third category, smart beta ETFs. These are the combination of active and passive investing. The goal here is to beat the market or to match it while taking on minimum risk. These ETFs are built on strategies and specific criteria which the underlying securities must meet to be included in the ETF. Smart beta ETFs might look at size, volatility, and value of an asset to qualify it. The most common example is dividend-oriented ETFs. It screens holdings for dividend growth. Smart beta ETFs exploit investing anomalies that have previously beaten the market in the long run. For example, undervalued companies or highly profitable companies or whose share prices have been on the rise in the last 12 months, or those that have a proven history of outperformance. The trick is to develop an index that filters out those companies that don't fit the criteria or the smart beta profile and focuses on those that do. For example, imagine how a typical passive ETF works. As we have discussed, it will follow a market cap index. It could be FTSE All-Share or S&P 500. Securities in these indices are tracked proportionally to their market value. What I mean is, if Microsoft is worth 5% of the market value of all the companies in the index, then in the index it will also be given a share of 5%. And then the ETF that replicates this index will normally hold 5% of its assets in Microsoft. And it is achieved by holding the same securities as the market which the index measures and in same proportions. That's a relatively simple process because it's the index that makes the fund manager's investing decisions. And for this reason, ETFs can charge extremely low fees. However, a smart beta ETF that's tracking undervalued companies will apply an algorithm to the market index. And this formula will increase the holdings of the stocks that look cheap and reduce the holdings of those stocks that look expensive. So, as a result of this screening, Microsoft might only end up being 2% of the smart beta index, or it might not hold it at all. There's also the possibility that if the algorithm finds that Microsoft is undervalued by industry comparison, it might increase the holding to 10%. This arrangement or formula to adjust the index is an attempt to beat the market by increasing holdings of companies that are cheap or undervalued. Overall, smart beta relies on the historical performance of companies to find out outperformers. But bear in mind that practically smart beta index are quite complex, and as an investor you must have thorough understanding of the index. Also, these are more expensive compared to typical passive ETFs, but still cheaper than their active counterparts. Smart beta ETFs use these qualifying strategies to pick assets. They might look at dividend growth or find utility companies through low volatility, or they might sift assets with small cap or quality, or these could use value as a qualifying mechanism. For instance, MSCI Europe Value Factor is a smart beta ETF. The stock selection is based on three value factors: price to book value, price to forward earnings, and enterprise value to cash flow from operations. Bond ETFs exclusively invest in bonds. They hold a portfolio of bonds with different strategies, from government treasury bonds to high yields with different holding periods. Bond ETFs are quite similar to plain equity ETFs in tracking indices. An example is iShares Euro Corporate Bond X Financials, which tracks the performance of an index, Bloomberg Barclays Euro Aggregate Corporate Bond, and this index comprises of euro-denominated investment-grade corporate bonds. And as the title suggests, the time to maturity of these bonds is 1 to 5 years. Another example is SPDR Barclays Emerging Markets Local Bond ETF, which tracks local currency emerging markets debt. Bond ETFs trade throughout the day on the exchange, which is different from trading actual bonds. Bonds are sold over the counter by bond brokers. Also, the price structure of bonds makes them less flexible in comparison to a bond ETF. So when you buy a share of the bond ETF, you get exposure to the bond market with the liquidity of the stock market. When you buy an actual bond, you get regular coupon payments. That's the main feature of a bond. But in contrast, bond ETFs pay the investor interest every month. The reason is that a bond ETF is holding different bonds with different maturity dates and timings for coupon payments. Commodities are highly valuable in diversifying your portfolio beyond the most asset classes of stocks, bonds, and liquid cash. And the reason is their low correlation to bonds and stocks. It's interesting to note that commodities outperformed both stocks and bonds during the hyperinflation episode of the 1970s. And this property of resilience against conditions that hit stocks and equities hard makes them a worthy asset when you're considering to develop an all-weather portfolio. Just to make sure we're all on the same page, commodities are the raw materials of global production. The main categories are agriculture, such as wheat, cotton, coffee; energy, oil and gas, of course; precious metals, including gold, platinum, silver; industrial metals, such as copper and zinc; and livestock, which includes pigs, cows, poultry. As with other ETFs, when you buy shares of a commodity ETF, you gain exposure to diversity offered by commodities. The operating principle is the same. A commodity ETF attempts to replicate the return of global commodities by replicating or tracking a commodity index and trading on stock exchange. You also have the option of tracking a single commodity, gold, for instance, and you do that by using an exchange traded commodity, or ETC. ETC is a little different from ETF. ETF is a fund, while an ETC is a debt instrument. The benefit of investing in an ETC is that it lets the investor circumvent European regulations that keep funds from concentrating their assets in a single holding. But since it's a debt instrument, there's a downside to it. It exposes you to credit risk. How do commodity ETFs work? The unusual part about commodity ETFs is that they don't track the current prices of commodities. They're reacting to their future prices. Now, this sounds a little strange, but there's a method behind it. Imagine you're listening to financial news channel and the reporter is talking about rising prices of oil. This price is the current price, also called the spot price. Simply put, if you want to buy a barrel of oil, you will have to pay this price or the spot price. And it can be about any commodity, gold, silver, wheat. The point is that you pay the spot price to acquire that commodity. But the case of commodity ETFs is different. The ETF manager is not physically storing any commodity. If that were the case, the manager would be charging huge amounts from investors for storing commodities like cows, oil, wheat, gold. So how do we solve the problem for the cost of commodities if the ETF manager is not physically storing them? The answer is that commodity ETFs trade in commodity futures and hence track the futures prices instead. Futures, as might you have known, are contracts where, for instance, you might commit to taking a delivery of 1,000 cows in 6 months from now at a particular price. The essence of future contract is that the investor gets exposure to the commodity without worrying about the noise, smell, and cleaning of 1,000 cows. What happens in commodity ETFs is that as soon as the delivery date approaches, the ETF manager sells the future contract to someone who is actually interested in taking the delivery of the cattle. Now, with this principle in mind, you can imagine how all the major commodity ETFs actually operate. In short, it involves the continual process of buying futures with long delivery dates and selling those future contracts whose delivery dates are approaching soon. This way, the investor need not worry about parking cows. This is how commodity ETFs provide exposure to indexes that track commodity futures. So we've discussed that commodity ETFs don't track spot prices. They operate on futures prices. Hence, you, the investor of commodity ETF, gets a return which is a blend of spot price fluctuations, interest rate earned on the collateral held by the fund, and rolled returns. Rolled return is the profit or loss that your fund makes by trading futures contract. The ETF manager buys futures contract with delivery dates that are significantly far off in the future and sells those whose delivery dates are getting closer. Or in the business language, it's the rolling out of short-term contracts and replacing them with long-term contracts. That's where the term rolled return comes from. The profitability principle in rolled return is simple. If the ETF buys the long-dated futures in a commodity for less than it sells its expiring short-dated futures, there's a positive rolled return known as backwardation. The opposite situation is called contango when the rolled return is negative, and it happens when the ETF manager buys the long-term futures contracts for more than what the short terms are sold for. And if you want to commit to memory the impact of contango and backwardation on your investment in a commodity ETF, think of contango as headwind that makes it difficult to move forward, and backwardation as tailwind that gives you a boost in moving ahead. These two factors are significant, and as an investor, you must take these into account since, depending on positive and negative roll, backwardation, or contango, respectively, the price of commodity futures can vary significantly from the spot price. And due to this uncertainty, it's advisable to acquire a broad-based commodity ETF rather than relying on a single commodity ETC. Again, we discussed that ETC means exchange traded commodity. Before investing in commodity ETFs, you must have comprehensive knowledge about the index it tracks. Commodity indexes are different from stock indexes since there's no common weighing factor such as market capitalization. So how do indexes weigh commodities? The mechanism varies from index to index. Some consider global production of a particular commodity and its inventory values. For instance, the Deutsche Bank Liquid Commodity Index tracks 6 commodities in energy, precious metals, industrial metals, and grain sectors. The weight to each commodity is assigned based on global production and inventory. Energy contracts are rolled monthly, while metal and grain contracts are rolled annually. Other indexes have their own ways of weighing commodities. Core Commodity CRB Index qualifies the weight of a commodity according to the liquidity, economic importance, and diversification potential. It indexes 19 commodities with 39% allocated to energy contracts, 41% to agriculture, 7% to precious metals, and 13% to industrial metals. The majority of indexes set an upper and lower limit of weight of commodity categories. Energy is a classic example. If these limits are not applied, one sector will dominate the index at the expense of other commodities. You can be specific in choosing an index according to your preference. If you want to avoid a particular category, say metals, you can do that. Then there are indexes that try to get as close as possible to the spot prices by favoring short-dated futures contracts. And then there are those that will try to prefer those commodities that are more likely to generate positive roll return or backwardation. For these reasons, it is imperative that you understand how different commodity indexes work. Regardless, commodities normally range between 5 to 10% in a portfolio. Even strong advocates of commodities allocate 10% or under to commodities in their portfolios. Money market is where highly liquid short-term financial instruments are traded. These include treasury bills, negotiable certificates of deposits, and similar securities. The maturities of these instruments range from overnight to just under a year, and naturally, there are indexes to account for the movements of this market. You must have guessed by now where this is going. There are ETFs that track the performance of these indexes, which are called money market ETFs. PIMCO US Dollar Short Maturity ETF is a huge ETF with a fund size of just under $3,000 million. It's an actively managed ETF by PIMCO, which stands for Pacific Investment Management Company. This ETF invests primarily in a diversified portfolio of US dollar denominated fixed income instruments. Similarly, PIMCO Euro Short Maturity ETF is another ETF with a fund size of just under 3,500 million euros. It's listed on the SIX Swiss exchange. As the name suggests, it is managed by PIMCO. Source, if you don't know, is one of Europe's leading providers of exchange-traded products. The strategy in this particular ETF is that it invests in euro-denominated investment-grade fixed income securities. These include government bonds, corporate debt, mortgage, or other asset-backed securities. It achieves exposure by using forwards and other derivatives. Forwards are similar to future contracts, but there are some differences. For instance, futures are traded on exchanges, while forwards are private agreements between two parties. Plus, you can customize forward contracts to almost any quantity, amount, and delivery date. Precious metals include gold, silver, platinum, and palladium. And precious metal ETFs track the prices of these metals. iShares Gold is the ETF that tracks, or aims to track if we want to be precise, the return of the gold spot price. This price of gold is in US dollar according to London bullion market at any given time. The Source Gold has a similar strategy, but it is an ETC. To understand real estate ETFs, it's important to know about REITs or real estate investment trust. It is a type of security that either invests directly in real estate, owning the property or mortgages, or a combination of these two. These often give high yields due to revenue from rental properties or mortgage interest payments. And investors get the benefit of owning real estate investments without actually creating a personal portfolio of real estate. Now, coming to real estate ETFs, such an ETF holds a portfolio of different REITs plus real estate derivatives. And just like with the ETFs we have discussed so far, the composition of the portfolio depends on its investment objective. You can go the difficult and expensive approach of getting the same results as a real estate ETF by looking for large, mid, and small cap REITs with some international exposure. Or you can attain the exposure to diversified real estate through REIT ETFs. An example is iShares Developed Markets Property Yield ETF. It tracks the listed real estate companies and REITs from developed countries, excluding Greece, that have a 1-year forecast dividend yield of over 2%. So we've been talking about how an ETF tracks an index and aims to replicate its performance. This replication is not 100% exact. There can be a difference depending upon different factors. This difference between the performance of the ETF and the index is called the tracking error. This is one of the key factors you must consider when buying an ETF. ETFs with the least tracking error are considered more efficient. One reason tracking error exists is that oftentimes ETF managers use a sample to replicate the benchmark index. They don't include all the securities or the companies, but just enough to replicate the index. Also, tracking an index sounds simple in theory, but in reality is a lot more complex, especially when there are several ETF operators competing against each other. It is worth mentioning that the average investor doesn't pay much attention to tracking error when he should be. Tracking error can become significant and can cause unexpected results. You must take care when choosing an ETF because you might look at an ETF that might offer lower fee than its competitors, but might also have a larger tracking error. There is a special type of ETF called the inverse ETF. It can make you money when the stocks go down, but it's more complicated than that. These ETFs are known as short ETFs or bear ETFs, and they're designed to return the exact opposite of their benchmark. The intent here is to profit from falling prices. ProShares and Direction are famous names among companies that offer a variety of inverse ETFs. How do they do it? How can they produce the opposite results, like when the stocks go down, the ETF goes up? They normally use derivatives to achieve such results. These funds can have a one-on-one correlation with the benchmark, or they can be leveraged. For instance, ProShares Short S&P 500 is designed to match daily returns of S&P 500 index, but in the opposite direction. This one-on-one correlation is such that on the day when the index goes up by 2%, the ETF should fall by the same percentage. A leveraged ETF, on the other hand, is designed to magnify the inverse effect of the benchmark index. For example, the Direction Daily Small Cap Bear aims to achieve 3 times the inverse movement of Russell 2000 daily performance. Simply put, when Russell 2000 drops by 2%, the ETF rises approximately 6%. But one thing you must absolutely consider is that the index performance is accounted for on a daily basis. Inverse and leveraged ETFs rebalance investment strategies daily to keep a constant leverage ratio, which is why they're more suitable for short-term trading strategies rather than long-term investment plans. You must have figured out that these are not as simple as some of the plain vanilla ETFs we discussed earlier. Without going into the specifics, just keep in mind that these are actively managed ETFs, which means that they have relatively higher expense ratios, usually around 1%. And due to daily rebalancing, they tend to underperform over the long periods. Total expense ratio is the total expense of managing and operating the ETF. These expenses primarily consist of management fee, trading and legal fee, and other operational expenses. The general formula to calculate the total expense ratio is total fund cost divided by the total fund assets. And you should look for a low expense ratio in an ETF, and it is something you must consider when buying an ETF, since this cost is covered by the money from the fund itself, which impacts investors' returns. For instance, if an ETF gives you return of 7% but has a total expense ratio of 2%, your gain of 7% is reduced to 5%. As a general rule, the more actively managed the fund, the higher its expense ratio, as the cost of personnel and transaction fee increases accordingly. The cost of owning an ETF is not completely captured in total expense ratio. Total expense ratio, or its lookalike OCF or ongoing charge figure, is an estimate annual cost of owning an ETF. These are the charges you see quoted on the website of the ETF operator. This cost is deducted pro rata on daily basis from your holdings, but this doesn't represent the full price that you pay. For that, we need to understand total cost of ownership. Total cost of ownership is hard to find on the website of ETF provider or on their fact sheet. The reason is that total expense ratio and ongoing charge figure are agreed upon between the investment industry and the European Union. The total cost of ownership is not defined. Regardless, as an investor, you must consider total cost of ownership because the ETF with the lowest expense ratio is not necessarily the cheapest. You'll need to do a little bit of work on how to find the total cost of ownership, but once you figure it out, it will save you money. The expense ratio and ongoing charge figure include the annual management fee plus other expenses such as index licensing fee, legal fee, administration, marketing, regulation, and auditing. Cost of ownership captures the internal costs. These normally include dealing fee, spread, and taxes, or in case of synthetic replication, swap fees, which are incurred on the underlying holdings of the ETF. Gains from security lending are also attributed to it. These fees are an inevitable part of running an ETF. In addition, there are external costs such as bid-offer spread, dealing fee, and platform charges when you trade an ETF. These costs are relatively visible to the investor. You can check with the ETF provider about their platform charges and trading fee. They're obligated to disclose such information. As far as the bid-offer spread is concerned, you can find it out by checking ETF prices. Bid-offer spread is the difference between the price you buy and sell for. Think of it as buying foreign currency when you go to a different country. The majority of ETFs we have looked so far are physical ETFs, meaning they replicate an index or benchmark by physically buying stocks, bonds, commodities, futures. They aim to invest in the same holdings as the index, which is why the return of the physical ETF is theoretically the same as the index it's tracking. For instance, an ETF that tracks FTSE 100 index holds all of the companies in the FTSE 100 in the same proportion to their weight in the index. But sometimes, physically replicating an index is not possible at a reasonable cost. If the market trades illiquid assets, the trading costs can get extremely expensive. There are other hurdles preventing to physically replicate an index such as tax and legal issues or various time zones of securities trading. To overcome these hurdles, a synthetic ETF creates a total return swap. What it means is that it uses a derivative contract provided by the counterparty, which is usually a global bank or the securities dealer. The way it works is that the counterparty, a global bank or a major financial firm, will provide the returns of the index, including dividends to the ETF. In exchange, the counterparty gets a fee as well as a return on the collateral posted on behalf of the ETF. This collateral acts as insurance for the ETF investors in case the counterparty defaults or fails to pay. Obviously, there is counterparty risk involved in synthetic ETFs. Cash invested in the ETF buys a basket of securities, which acts as a collateral. In case the counterparty fails to pay, this collateral is sold and the proceeds are returned to the investors. iShares Diversified Commodity Swap ETF tracks the price of futures contracts on 20 commodities. Synthetic ETFs provide a low-cost way to access those markets which otherwise would be off-limits for average investors. They undercut their physical rivals with lower ongoing charge fee and tracking error as they're not physically tracking an index. Usually investors have lots of questions about ETFs. Here I'll try to cover some of the most common questions. So where and how to buy the ETF? Think of the places where you would normally buy the stock of a company since ETFs are traded just like stocks. You can do it at SAMT AG. When you buy ETFs through online brokers, it's not very expensive. The actual buying process doesn't take very long. And the selling process is similar. You sell it through the dealing service where you bought the ETF at and are holding it now. How do I make an ETF portfolio? This is the real question. As an investor, you must focus on developing the portfolio, which is optimized, diversified, and a portfolio that fits your investment plans. If you want to make an optimized ETF portfolio for free, you can make it at ways2wealth.com. It's a non-profit service, which means first, it's free forever, and second, it's completely independent. Also, if you're interested in developing portfolio through a licensed wealth manager, you can do it at SEMT AG. The managers here utilize enduring core concept with lower risk through diversification. Now, this is important because there is a misconception that when you diversify your portfolio, your income decreases, which is not true really, because if the portfolio is compiled properly, and I stress properly, it can match the return of a non-diversified investment, but at lower risk. What to do when the market falls suddenly? You must stick with your core investment strategy. If your investment plan is to hold for the long term, then by all means hold it. If your strategy is to hedge your portfolio, then hedge it. The point is, you should follow your investment strategy. If you panic and sell during crash, there's a high probability that you will suffer a loss. Are there any additional charges? We've covered costs of ETF in detail. To sum it up, ETFs charge an annual fee which is automatically deducted from the returns of ETFs. You don't pay it separately. How much are these? These can be as low as 0.5 to 1%. However, your broker or fund platform will charge a fee as well, so you'll need to compare prices of brokers to find the most feasible for you. When can I buy an ETF? ETF shares are traded in the stock market, so you can buy anytime during market hours. If you're in the UK, that would be from 8 in the morning to 4:30 in the evening. By the way, the best time to buy ETF shares is at the opening hours of the home market of ETF's underlying holdings. At this time, you get better liquidity and low spreads. Is there a lock-in agreement with ETFs? No, there isn't. ETFs are freely traded. There's no agreement or an obligatory holding period. You can hold them as long as you want. What are the best ETFs? Best ETF depends on the investor. Professionals or qualified portfolio managers win because they develop and readjust strategies. Regular folks lose money in the market due to psychological reasons. For instance, a common observation is that the moment they lose a little money in the market, they panic and sell everything they have. Whereas professionals use financial strategies such as hedging portfolios with options if they find that the risk is significant. Strategy is key in successful investing. Average investors think they have a strategy, but they really don't. For instance, popular quotes and phrases such as "don't put all eggs in one basket" are good, but they hardly qualify as a strategy. A strategy has a well-defined goal and the means to get there. There is science behind investment strategy. Strategy becomes critical when you consider investor psychology, which is basically the deciding factor between success and failure. The average investor loses money in the market because of how he reacts to market movements. The general investment cycle for the average investor is they invest in the market with optimism. On the surface, everything looks fine. The investor has done his homework as much as he could about securities. When the market is moving up, everything seems nice. The investor quickly moves from optimism to excitement. And if the market overcomes a small dip, he gets thrilled. And finally, when it reaches a high, something like a record or a psychological barrier where the index had never gone before, the average investor becomes euphoric, the top of the world feeling. But then when the market moves down, euphoria is quickly replaced with anxiety. When it keeps moving down, the investor shows resilience that this phase is temporary, that I'm a long investor. But when things don't improve, fear takes the driving seat, and that's when things start to go really bad. In desperation and panic, he would try to sell, but it's already too late. Then there is capitulation where all hope is gone. And when index hits rock bottom, there's despondency where the investor tries to figure out, how could I be so wrong? How could I not see this coming? And then when the market starts to move up, depression is replaced with hope and relief, and finally we're back to optimism. And then the cycle repeats. Most investors don't even get to break even with their investments, And when the market is recovering, there are new investors who enter with optimism. Since 1997, there have been two major market crashes, the dot-com bust and the housing market crisis. If you take a look at the graph, this investor psychology cycle fits well on these. This is the S&P 500 index. If you look at the period from 96 to 2003, we can pinpoint the phases which the average investor went through, starting with optimism in 1997 to euphoria when the index crossed 1500 points, and then the downward spiral of anxiety, fear, panic to despondency. The same story repeats from 2003 to 2009. The average investor went in with high hopes, became euphoric when index crossed 1500 again, and then crash. It dropped below 750, and in the state of despondency, the average investor kept wondering, how could I not see that? Fast forward to today. Since 2009, the markets have been moving up. We've already crossed the phases of optimism, excitement, and thrill, and living in euphoria as S&P 500 is approaching 3,000 points. But we all know what happens next. Coming back to ETFs, these are diversified and cheap financial instruments, which makes them a must for a balanced portfolio, especially for the average investor. Let's assume that you've made your investment portfolio. But making an optimized portfolio is one thing. Protecting or hedging it is another. In the simplest terms, hedging in finance means to decrease or to transfer risk. Let me show you how you can hedge your portfolio with a cost-effective strategy using options. I've covered the basics of call and put options in detail in a separate video. The link should be somewhere in the description, so if you're not familiar with options, feel free to watch that one. You can use a put option to hedge your investment. For instance, you have a portfolio of 100,000 euros and you buy a put option for 100 euros, the right to sell your portfolio at 95,000 euros. Since the price of the asset is greater than the strike price, it's an out-of-the-money hedge, which makes the option cheaper to buy. Let's see how this hedge will work. Your portfolio falls to 60,000 euros, but your option gave you the right to sell it for 95,000 euros. Despite a huge drop of 40% in your portfolio's value, you didn't lose much. In the second scenario, your portfolio's value goes up to 120,000 euros. Your put option for 100 euro expires worthless, which is a tiny loss since you just made a healthy 20,000 euro profit. If you just hedge against extreme volatility, it's not very expensive, and for a long investment horizon, it is beneficial if you don't have huge losses. The average effect makes you a winner. In this webinar, we have learned how the performance of the stock market offers great investment opportunity. The S&P 500 performance over the past 50 years has been nothing short of phenomenal. Then we dug deep into ETF or exchange traded funds, which are securities that combine the benefits of mutual funds and stocks. These are liquid, cheap, and trade on stock exchange. Then we looked at indices that they measure market movements and some of the major indices. We also covered types of ETFs such as equity, bond, commodity, smart beta, and inverse, and also covered some common questions about them. Then we defined investment strategy and looked at investor psychology, that why average investor loses money in the market. Then briefly, we looked at how easy it is to hedge your portfolio using options. In the last part, we saw the difference between the average investor and professionals, that how the average guy struggles in the market and why it makes sense to hire a professional for better investing decisions. At SamDaisy, you can open your digital account online. We make diversified ETF portfolios using special algorithms that show optimized risk to return ratio. The strategy is such that your positions don't need changing for a long time, and under normal circumstances, reinvesting dividends proves sufficient to adjust assets in the changing market. Simply visit samt.ag and click the button that says Build Your Portfolio. The process is without any obligations. You can cancel anytime. At the end of the process, you can schedule a telephone call with Dr. Ulbrich, the head of the board at SamtAG. The ETF universe is constantly expanding. I've tried to cover as much as I could in a limited time. If you have any questions, you can ask them in the chat box, or you can email me here at this email address. I'm Niall from SamTG. See you soon.